And welcome back to KTLA News. I'm your host, Andrew Young. It's a beautiful 10 a.m. Monday morning, and that brings us to the stock market segment of the day, where today's top story comes once again from Reddit's Wall Street Bets community, where just weeks ago they made headlines by sending GameStop into a short squeeze frenzy. Today, it seems they found their next target, the unassuming toy company Hasbro, whose stock is up nearly 4.2% just 3.5 hours into the trading session today. We've managed to interview some of their users. Let's see what their thoughts are on this potential hot stock that they want to send to the moon.
Hasbro likes to describe themselves as a global play and entertainment company committed to creating the world's best play and entertainment experiences. This is the first thing that you see when you log on to Hasbro's investor relations website, and all they're saying is that they are part of the entertainment industry. So we all know that the entertainment industry is rather large, but because of how they market to a younger demographic with their intellectual properties like My Little Pony, Peppa Pig, and the Monopoly Man, they fit a very niche subsect of the entertainment industry. So this puts them up against competitors like Mattel with Barbie and Lego with Lego Ninjago. So when the economy is doing well, so is Hasbro, obviously, because parents are streaming more of them delightful Peppa Pig episodes. They're buying more Peppa Pig play sets for their children, and Hasbro's getting that sweet cash from them. So why are you still thinking about buying this Hasbro stock? Go buy that sweet Peppa Pig merchandise, son.
Hi, this is Terry. Today I'm talking about the most significant assets and the company's strategy. About Hasbro, I just want to prove my idea why Hasbro is a strong buy stock. The Hasbro's most significant asset is cash. It's around 45-80 million US dollars in 2019. That's a huge increase from 2018. It's about 12 million US dollars. The main reason of this jump is because Hasbro acquired the Canadian studio Entertainment One. Hasbro earned industry attention through the acquisition of the companies with house-style products, relying on the numbers of large IP to complete their original accumulation. Based on my knowledge, they acquired like Special Force, Pony, and Transformers. Hasbro's strategy is integral through the designing, manufacturing, and marketing its products through continuous innovation to accumulate more brands and make the positive cash flow. However, Hasbro does not produce any raw materials for its products. It does not do any direct selling to customer, which means they make their toys to the construction factory, like third-party factories. Some of the factories in China, and now they transform to like the Vietnam or somewhere else, and they sell their products through the supermarkets like Walmart, Target. This strategy is greatly reduced companies' operating cost. Low operating cost and high efficiency has improved the profitability of this company. We can take a look at the inventory, which has been kept very low, and it fits the company's long-term strategy. Goodwill and other intangible assets, it's around 12 million US dollars. It's still a big part of company assets. I do believe it's just like Disney. The goodwill and the other intangible assets is very high, which means it's due to the concession and some meaningful brands value such as Transformers in people's mind.
All right. I know this is Wall Street Bets, but let's still take a look at some of the key risks that Hasbro faces. I did some research, and it looks like there's two main risk factors affecting the company. First off, as disclosed in their 10K, Hasbro's made a strategic decision only to focus on a key number of brands and franchises. These brands are big deals. We're talking Nerf, Play-Doh, Transformers, Monopoly, etc. And Hasbro's exclusive rights to produce toys for some key partner brands like Marvel, Frozen, and Star Wars. Now, these are some killer names, and management has decided that instead of working to create new brands, they're going to focus on growing sales for these brands across the globe. Now, this is a risk because if just a few of these brands fail to gain appeal in management's targeted growth areas, such as Asia, Hasbro's revenues could seriously take a hit. In short, they're not very well diversified, and they're doubling down on their current winners. There's upside here too, though. Reward is a function of risk, and if these brands and partner brands really gain traction abroad, we could see huge sales growth. Plus, globalization and the internet have created an environment much more conducive to brands with cross-cultural appeal. Frozen and Marvel have seen huge success all around the world, and I think that's an indication this strategy could really pay off.
About the 6 ratios and why they're important to Hasbro. Before I start about talking about the ratios, it's important to mention that there was a significant acquisition made in December of 2019 that had a significant impact. To expand its growing digital business segment, Hasbro acquired Econ on December of 2019 for $4.6 billion. So first we'll look at the profitability ratios. It is important to analyze gross margin, operating margin, and net margin trends of the company to understand the economics, financial health, and investment attractiveness of the company. Looking at Hasbro's gross margin, we see that it has improved significantly in 2020 by 7% due to the increase in entertainment and digital revenues. Digital revenues have lower cost of sales than physical goods and also have increased in the year of 2020 due to improved inventory costing. Now looking at the liquidity ratios, we've seen that the interest coverage ratio has dropped to 2.5x, which is not ideal. However, since it is higher than 2x, it's not a matter of concern. The current ratio has also dropped to 1.6 due to the financing of Ray's acquisition. In terms of working capital management, Hasbro has done a great job at managing its working capital and significantly reduced its net working capital days in 2020. Overall, the financial health of the company looks good, and the liquidity ratios will improve in 2021. Now let's take a quick look at our nearest competitor, Mattel. Looking at their profitability ratios, we see that the gross margin is a good indicator of the profitability of the enterprise, and that is a lot lower than Mattel as compared to Hasbro. Hence, the business model of Mattel is inferior to Hasbro in terms of long-term profitability. There was a significant decline in restructuring costs from 2019 to 2020, and because of the restructuring program, that led to a jump in profitability and increase in equity in 2020. The key question now is if these savings are sustainable. The revenue growth is still anemic, and just cutting costs will not create a sustainable path to expand profitability.
Let's take a look at the chart of Hasbro now, and let's see how the stock has been performing. Hasbro has been trading in this light blue upward channel since about May of 2020 and is quickly approaching one of its resistance points at about $100. And this is all still within a sideways consolidation, which started in 2015. And with good news and good numbers, we could see Hasbro break out with enough momentum to hit its targets of $110 and an all-time high of $124. Now this comparison with Mattel, which is the orange line, we can see a similar stock performance with Hasbro until about 2014, where Mattel quickly started underperforming Hasbro in the overall broad market. Since the beginning of 2014 until now, Hasbro is sitting at 85% return, while Mattel is sitting at negative 50%. Another positive for Hasbro is that it boasts a 2.87% dividend yield, so that even in downturn or sideways trading, shareholders can continue to make returns.
If you are still not convinced that Hasbro is going to the moon, think about this. One of the most important things about buying a stock is buying at the right time. Right now is prime time to buy the dip. We estimated a share price of $123.95, which is 31% higher than the current trading price. In our growth forecasts, revenues are highlighted by a huge 15.7% growth in just 2020 alone. Hasbro's ability to generate free cash flows with a low cost of goods sold average of 30% lets us believe that it is not unrealistic to break all-time highs of $122. To put Hasbro's valuation in perspective, the competitor Mattel has an estimated share price of $14.59, which is 5% less than the current trading price of $20.06. Similar calculations were used that we used for Hasbro, and the difference in valuation can be attributed to Hasbro's great ability to generate free cash flows with a low cost of goods sold, along with a very bright future outlook with Hasbro's roadmap, especially with the acquisition of Econ. For our calculations and comparisons, we believe that Hasbro is trading at a discount and that it is prime time to buy the dip.